Listen, I want to show you something that happened this week that most people are going to completely misunderstand. JP Morgan, one of the largest investment banks on the planet, just confirmed their gold price forecast for 2027 at $5,400 per ounce. Not 5,000, not 5,100, 5,400. And while everyone is focused on that number, I want to show you why I think they are being too conservative. Not by a little, by a lot. Let me walk you through what JP Morgan actually said, what the data behind their forecast reveals, and why the structural forces driving this gold and silver bull market are stronger than even Wall Street's most optimistic analysts are willing to publicly acknowledge. Start with the official JP Morgan forecast, because this is not speculation and it is not hype. This is JP Morgan Global Research, published and publicly available. Gold prices are expected to average $55 per ounce by the fourth quarter of 2026, rising toward $5,400 per ounce by the end of 2027. That is their base case, not their bull case. Their standard forecast assuming things proceed relatively normally. Natasha Kaneva, head of global commodities strategy at JP Morgan, put it directly. While this rally in gold has not and will not be linear, we believe the trends driving this rebasing higher in gold prices are not exhausted. That phrase, not exhausted, is Wall Street language for we think this has a lot further to run, but we are not going to say it too loudly because we do not want to look foolish if we are wrong. Now let me show you what is hiding inside that forecast, because this is where it gets interesting. JP Morgan is projecting that central banks will purchase approximately 755 tons of gold in 2026. That is down from the peak of over 1,000 tons per year for the last 3 consecutive years. And JP Morgan describes that decline as mechanical rather than structural. What does that mean? It means central banks are not buying less gold because they want less gold. They are buying fewer tons because at $4,000 per ounce and above, they do not need to buy as many tons to reach their desired percentage of reserves held in gold. When gold was $2,000, a central bank needed to buy 1,000 tons to get $10 billion worth of gold. When gold is $4,000, that same central bank only needs to buy 500 tons to get the same $10 billion of value. The demand is the same. The ton count is lower because the price is higher. That is mechanical, not structural. But here is what JP Morgan is not saying loudly enough. Even at 755 tons, central bank buying in 2026 is still nearly double the pre-2022 average of 400 to 500 tons. The new normal for central bank gold buying is roughly twice what it was for the entire decade before 2022. That is not a temporary spike. That is a regime change. And JP Morgan is embedding that regime change into their $5,400 2027 forecast as if it is a conservative assumption. It is not conservative. It is the most bullish structural shift in gold demand in 50 years. And they are treating it like business as usual. Now let me show you the investor demand side, because this is where I think JP Morgan is being even more conservative. Gregory Shearer, JP Morgan's head of base and precious metal strategy, noted that gold accumulation by central banks and investors in the third quarter of 2025 reached 980 tons. That is 50% higher than the average of the previous 4 quarters, not 5% higher, 50%. And that 50% increase happened while gold prices were already at all-time highs above $4,000. When demand accelerates by 50% at record high prices, that is not normal market behavior. That is panic buying. That is strategic repositioning. That is entities deciding they need gold regardless of what it costs, because the alternative of not having it is worse. JP Morgan is forecasting that investor and central bank demand will average approximately 585 tons per quarter in 2026. That works out to roughly 2,300 tons annually when you combine central banks and private investors. And JP Morgan says that the relationship between quarterly tons of demand and price, explains around 70% of the quarter-on-quarter change in the price of gold. As a rule of thumb, around 350 tons or more of quarterly net demand from investors and central banks is needed to sustain upward price momentum. JP Morgan is forecasting 585 tons per quarter. That is 67% above the threshold needed for sustained price increases, and their price forecast is 5,400 by late 2027. Do you see the disconnect? They are forecasting demand that is 67% above the level needed to drive prices higher, and their price target assumes that demand only drives gold up another 25% from current levels over the next 21 months. That math does not add up. Either their demand forecast is too high or their price forecast is too low. I think their price forecast is too low. Let me show you why by walking through what is actually driving this demand and whether those drivers are likely to weaken or intensify over the next 2 years. The first driver is central bank diversification away from the US dollar. The World Gold Council surveyed central banks and found that 95% of them expect global gold reserves to increase in the next 12 months. Not 50%, not 70%, 95%. And here's the critical detail. Zero central banks surveyed expect gold reserves to decrease. When you have 95% consensus that reserves will increase and 0% expecting a decrease, that is not a market with two-sided risk. That is a market with one-sided structural buying pressure. And that buying pressure is not sensitive to price. Central banks are not traders. They do not sell when price goes up and buy when price goes down. They accumulate toward a target allocation percentage and they hold for decades. That demand is structural, not cyclical. The second driver is the Federal Reserve rate cutting cycle. JP Morgan's forecast assumes the Fed will cut rates by approximately 100 basis points by the second quarter of 2026. Lower rates reduce the opportunity cost of holding non-yielding assets like gold. When you can earn 5% on cash, gold needs to compete with that 5% yield by appreciating in price. When rates drop to 3%, gold only needs to beat 3%. The lower the risk-free rate, the more attractive gold becomes on a relative basis. And here is what makes this particularly important right now. Real yields, which are nominal interest rates minus inflation, are the single strongest predictor of gold price direction over time. When real yields fall, gold rises. When real yields rise, gold falls. JP Morgan is assuming real yields decline through 2026 and 2027 as the Fed cuts rates while inflation remains sticky above the 2% target. Falling real yields, plus structural central bank buying, plus accelerating investor ETF inflows is the triple combination that historically produces sustained gold bull markets measured in years, not months. Now let me address the geopolitical and currency debasement angle, because this is where I think the real upside lives that JP Morgan is not fully pricing in. JP Morgan describes gold as serving a dual role, functioning simultaneously as a hedge against currency debasement and as an alternative to US Treasuries and money market instruments. That dual role is new. For most of the last 40 years, gold was primarily a safe haven asset during crises. You bought gold when you were scared. You sold it when the crisis passed. That is not what is happening now. Gold hit all-time highs in 2025, while the S&P 500 also hit all-time highs. Gold and equities rallying together is historically unusual. It suggests that the demand for gold is not fear-driven crisis hedging. It is strategic portfolio rebalancing driven by long-term concerns about currency stability and fiscal sustainability. The U.S. federal debt is currently above $36 trillion. The annual deficit is running above $2 trillion. Monthly interest payments on that debt are approximately $175 billion. For context, the entire U.S. defense budget is roughly $900 billion annually. The country is spending nearly as much servicing existing debt every 6 months as it spends defending itself for an entire year. And there is no plausible political scenario where that debt gets paid down. Neither party has proposed credible deficit reduction. Neither party has the votes to pass it even if they proposed it. The trajectory is more debt, higher interest costs, and either inflation to erode the real value of that debt or financial repression to keep nominal yields artificially low, while inflation runs above those yields. Both of those outcomes are bullish for gold, and JP Morgan's $5,400 2027 forecast assumes that trajectory continues but does not accelerate. What if it accelerates? What if deficits widen further because of recession, war, or political dysfunction? What if inflation reaccelerates to 4 or 5% and the Fed cannot raise rates because the debt service costs would become politically and economically unsustainable? That scenario is not being priced into JP Morgan's base case. And in that scenario, gold does not go to 5,400. Gold goes to 6,000, 7,000 or higher. Let me also show you what other major banks are forecasting, because JP Morgan is not alone, and the consensus is tighter than most people realize. Goldman Sachs recently revised its year-end 2026 forecast upward to $5,400 per ounce. Wells Fargo Investment Institute lifted its year-end 2026 gold target to $6,100 to $6,300 per ounce. Bank of America is targeting $5,000 by 2026. Deutsche Bank estimates $3,900 per ounce as support in 2026, meaning they think the floor, the downside protection level, is $3,900. The unweighted consensus across major institutions falls within a range of $4,800 to $5,000 for 2026. And multiple banks, including Wells Fargo and some independent analysts, are publicly discussing $6,000 as achievable within the next 12 to 18 months. When you have that kind of clustering around 5,000 to 6,000, with some outliers as high as 6,300, it tells you the street has repriced gold structurally higher. This is not one rogue analyst. This is institutional consensus forming in real time. Now let me pivot to silver because everything I just described for gold applies to silver with significantly more upside leverage. Silver has the same monetary demand drivers as gold: central banks diversifying reserves, investors hedging currency debasement, safe haven flows during geopolitical stress. Silver gets all of that. But silver also has industrial demand that gold does not have at the same scale. Solar panel manufacturing, electric vehicle production, electronics, AI data centers, all of these require silver. And the demand growth in those sectors is not speculative. It is contractually committed. Solar installations are forecast at 700 to 750 gigawatts in 2026. Each gigawatt requires millions of ounces of silver. That demand does not go away if gold prices move higher or if the Fed cuts rates. It is independent, structural, and growing. The Silver Institute confirmed the sixth consecutive year of structural supply deficit for silver in 2025, 67 million ounces more demand than supply. Global mine production is projected to increase by just 1% in 2026 to 820 million ounces. Recycling jumped 7%. But still only accounts for about 200 million ounces. Total supply, including mining and recycling, is approximately 1.05 billion ounces. Total demand is approximately 1.12 billion ounces. The gap is being filled by drawing down above-ground inventories, and those inventories are not infinite. Eventually, either price has to rise enough to destroy demand, or supply has to increase enough to meet demand, or you get a physical shortage where buyers cannot source metal at any price. I think we are moving toward that third scenario faster than markets are pricing. Here's why I am optimistic in a way that JP Morgan's $5,400 forecast does not capture. The forces driving gold and silver higher are not temporary. They are structural. Central banks are not going to wake up one day and decide they have enough gold. They are going to continue accumulating toward target allocation percentages that are higher than where they sit today. Investors are not going to suddenly trust fiat currencies more than they do now. The fiscal situation in the US, Europe, Japan, and China is getting worse, not better. The geopolitical fragmentation that is driving countries to diversify away from dollar reserves is accelerating, not reversing, and the industrial demand for silver from solar, EVs, and AI is locked in by manufacturing capacity that has already been built and supply contracts that have already been signed. When you stack all of those drivers together, JP Morgan's forecast that gold averages 50.55 by Q4 2026 and 5,400 by end of 2027 feels conservative. It feels like they are building in a margin of safety because they do not want to be the bank that called for $6,000 gold and then had to walk it back if something disrupts the trend. But I do not think you need to be that conservative as an individual investor. You are not a bank protecting your reputation. You can look at the same data JP Morgan is looking at and draw more aggressive conclusions. And here is what the data tells me. If central banks buy 755 tons in 2026, if investor demand remains at 585 tons per quarter, if real yields continue falling as the Fed cuts rates, if geopolitical tensions remain elevated, if fiscal deficits continue widening, then gold does not go to 5,400 by late 2027. Gold goes to 6,000 or higher by late 2026. And if gold goes to 6,000, silver does not stay at $78 where it is trading today. Silver goes to 100, 120 or higher because the monetary premium expands and the industrial supply deficit forces manufacturers to bid higher to secure metal. Let me show you JP Morgan's bull case scenario because they actually published one and it is substantially higher than their base case. JP Morgan modeled a scenario where investors of all forms continue to add gold at a rate similar to or even above the rate seen over the first year of Trump's second term. If you assume average quarterly central bank purchases of approximately 8 million ounces, quarterly ETF flows of 4 to 5 million ounces, and ongoing erosion in real yields in the US dollar, JP Morgan's bull case brings gold prices to approximately $6,350 per ounce by Q4 2026 and $8,650 per ounce by Q4 2027. Those are JP Morgan's numbers, not mine, not some random internet analyst. JP Morgan, one of the most conservative institutions on Wall Street, is publicly modeling a scenario where gold hits $8,600 by the end of 2027. And they are describing that scenario as requiring investor behavior similar to what we have already seen in the first year of Trump's second term. That behavior is not hypothetical. It already happened. We already know investors are capable of buying at that pace because they just did it for 12 months. If they do it again for another 18 months, JP Morgan's own model says gold hits $8,600. Now let me address why I think JP Morgan's base case is more likely to end up looking like their bull case than their bear case. The base case assumes normalcy. It assumes geopolitical tensions stabilize. It assumes fiscal deficits do not widen dramatically. It assumes inflation stays around 2 to 3%. It assumes the Fed successfully engineers a soft landing with moderate rate cuts and stable growth. Every one of those assumptions requires things to go right. And over the last 5 years, how often have things gone right? COVID, supply chain collapse, inflation spiking to 9%, multiple regional bank failures, geopolitical fragmentation accelerating, U.S.-China tensions intensifying, wars in Ukraine, Gaza, and now potentially Iran. The base case assumes we return to stability. The evidence of the last 5 years suggests instability is the new normal. And if instability is the new normal, then JP Morgan's bull case assumptions are more realistic than their base case assumptions. Let me also talk about what makes me genuinely excited as someone who holds physical silver and who believes in this thesis long term. The structural deficit in silver has now persisted for 6 consecutive years. That is not a temporary imbalance. That is a market where supply cannot keep up with demand at current prices. And the reason supply cannot keep up is not that miners are lazy or incompetent. It is that silver is predominantly mined as a byproduct of copper, lead, and zinc mining. Only about 30% of global silver production comes from primary silver mines. The rest comes from mines that are primarily extracting other metals, and silver is a secondary output. That means even if silver prices double, most silver mine production does not respond because the mines are optimized for copper or zinc economics, not silver economics. The supply curve for silver is far less elastic than the supply curve for gold. When gold prices rise, gold miners can ramp production relatively quickly because they are optimizing specifically for gold. When silver prices rise, most silver production does not respond because the miners are not primarily silver miners. That inelasticity is what creates the conditions for explosive price moves when demand surges, and demand is surging from multiple independent sources simultaneously. Here is what I want you to take away from this. JP Morgan, Goldman Sachs, Wells Fargo, Bank of America, and virtually every major institution covering precious metals is bullish on gold for 2026 and 2027. Their base case forecasts cluster around $5,000 to $5,400. Their bull case forecasts go as high as $8,600. And every one of those forecasts is built on assumptions about central bank buying, investor demand, and real yields that are either already happening or are highly likely to happen based on current policy trajectories. You do not need to be a conspiracy theorist to believe gold is going higher. You just need to believe that JP Morgan's research team knows how to read central bank data and model investor flows. And I think they do. But here's where I differ from JP Morgan. I think their base case is too conservative because it assumes stability that I do not think is coming. I think their bull case is more realistic because it assumes investor behavior continues at the pace we have already seen, which is a much safer assumption than assuming that behavior suddenly reverses for no reason. And I think silver, which is not even the primary focus of these bank forecasts, has significantly more upside than gold because of the industrial demand layer that gold does not have and the supply inelasticity that gold does not face. JP Morgan says 5,400 by late 2027. I think 6,000 by late 2026 is more likely. Wells Fargo says 6,100 to 6,300 by end of 2026. I think that range is achievable and possibly conservative if geopolitical or fiscal stress accelerates. And for silver, I think the gap between current prices around $78 and where prices need to be to balance the structural deficit and incentivize enough new supply is much wider than most analysts are modeling. Silver at $150 is not a moonshot prediction. It is what the supply-demand math requires if the deficit persists for another 2 years and industrial demand continues growing. So here is my optimistic take. The banks are bullish. The data supports the banks being bullish. The structural drivers are all still intact and in many cases accelerating. And the downside scenarios that would invalidate the bullish case all require things to go right in ways that recent history suggests are unlikely. I am not saying gold and silver go up in a straight line. I am not saying there will not be corrections, consolidations, and scary moments along the way. I am saying that the trend is your friend. The institutions with the most resources and the best data are betting on higher prices, and the structural case for owning physical gold and silver has never been stronger in my lifetime. JP Morgan says 5,400. I say they are being too careful, and I think the next 18 months will prove that the bull case was always more realistic than the base case. Stay optimistic, stay positioned, and trust the data over the headlines.